My name is Donald Baio, or you can call me DB. I'm the founder of Order Flow Analytics, and I'm not a big fan of long, boring bios and all of that, so I'll keep it fairly short. Tick-by-tick futures data is really the central aspect of my trading. It has been for about 7 years now. I'm a full-time trader. I'm not some book writing guru or anybody like that who hadn't really put on a trade in 15 or 20 years. I'm going to mix up the event today a little bit by throwing in some game theory into the discussion. We've done this in the last few presentations that I've given to help illustrate really the value of the information available to you as a trader. And some get it and some don't, and there's a good correlation for some, but we'll see how it goes today. After the presentation, I'm happy to actually walk you through the software. I was just looking at some of the charts from today. I wasn't trading today. And it's funny how the euro traded today because it's almost exactly what we're going to be talking about. So it'll be worth looking at actual data as well. Anyway, let's just kind of get into it. I'm going to start with talking about game theory a little bit, and that is the study of strategic interactive decision making. It's like microcosms of human interaction. So if you think of various groups of individuals like you and me and them, and then realize that each of us have our own beliefs and goals and information. On top of that, we're all trying to figure out the best way to respond to the decisions of others. And that's really what trading is. I mean, this is kind of a broad scope on how you interact with traders as well as many other things in life. Game theory is pretty complex. It's a branch of economic theory, and it uses really simple scenarios, or what we call games, to illustrate various strategies, theorems, classes, and equilibrium. Basically, game theory is very complex in that it's got a bunch of different branches of strategies and theorems and classes and all of these kind of complex natures. But the idea that you should recognize is that the basis behind it is that we use these very simple games to model kind of complex things that go on in the world. So whether it's, in our case, something to do with financial markets or geopolitical or economic based, you'll see that the games that we come up with are really very basic, but the idea behind it is that they're analogies for the more complicated games that we face in life, and they correlate very well. Okay, so today I don't really have any intention on trying to teach you all of the strategies, theorems, and equilibrium of game theory. That's for several classes, but instead I'd like to provide some really broad strokes on how we can relate game theory to trading. And I'm going to be talking about futures trading. I know that there are people in this group that do a lot of different trading. Please don't think that it's exclusive, that the content's exclusive to futures. That's just what I trade, and so I don't want to step outside my comfort zone and talk about something that I don't have any idea about. There will be some things that you'll note when we get into actually talking about reading the print, in that there are obviously instruments that have spreads, so just keep in mind the context of what I'm talking about is futures, but in a whole it applies to everything that we do regardless of what your instrument or market is. So I thought the best way to do this would be that we start with a game, and in this game the way this is going to work is that I'm going to give you $100. Now obviously I'm not really going to give you $100, but in the game today I'm going to give you $100 and a button. We're going to assume that there's 100 people in here, just an even 100, so that we can all keep the math straight. Okay, so everybody has $100, a button, and there's 100 of us. And really the only thing that we're going to have to do is decide whether to push the button or not. Now that seems a little odd because we don't really know what it does yet, but our job here is going to be to decide on a strategy that will maximize our payoff, our best possible payoff. And in order to do that, we have to use the information that we know, or what we think we know, about the other players that are in the game. And like I said, at this point, we really don't know anything. We have to understand what it does. So let's talk a little bit about what this button does. The first thing we should note is that there's two different ways that this can affect you. In the case of not pushing the button, we really don't have any effect. It doesn't do anything to the game. If you don't push the button and nobody else pushes the button, then everybody gets to keep the $100 that I'm giving you. But if we push, then it has two effects. One that affects you individually and one that affects everybody else. And that's a lot like trading also, which is really what makes it interactive. In order to For something to be interactive or be a game, we have to have the choices of others affect our outcome. So we know that not pushing really means that everybody would get to keep $100, but wins if you push. So if you push, we're going to take away $2 from every other player. Now, I'm not saying that you're actually stealing it from the other player. Okay, everybody else would have 98 and you'd still have 100. So what you're really doing is just being a bit evil and taking away $2 from everybody else. But you have to keep in mind that if everybody else pushes, it's going to take away $2 from you and every other player. So for example, if 70 people push, you'd end up losing $140. Right? Now I only gave you $100 to start with, so that means you're $40 in debt right there. Okay, but there's a way out of this for you, and this is one of the things that you need to understand. If you push, it has two effects. Okay, one on you and one on everybody else. The effect on you is that it cuts the damage caused by somebody else by 50%. So in other words, if somebody else pushes, if Mike pushes his button, instead of losing $2, if you push your button also, you'd only lose $1. So in the same scenario, if 70 people push, you'll only lose $70. So only lose $70, but you'll get to keep $30 profit. Okay, so before we make a decision on something like this, we need to kind of think about, a few lines of thought here. Okay, let's consider a few lines of thought. Okay, the first one, to me, I think it's really obvious. We all know how the game works. If nobody pushes the button, everybody gets $100, right? So I might not even be concerned about being a nice person. I don't really have to be. We can all get $100, so I'd kind of be crazy to push. And I think that's a pretty good argument. Or you can think about it this way. There's 100 people here that you don't know. Some of them are going to push the button, right? I mean, no matter what the other people do, I'm as well off pushing as not pushing. If I don't push, I could end up $98 in debt. If I push, at least I end up breaking even. Again, I'm a good person, and I'm thinking about pushing. I can imagine what other people are thinking. I have to push in self-defense. Or there's another line of argument. I'm not going to push. I'm not going to push because it's the right thing to do. I could lose $100 and I could go another $98 in debt, but it's worth it for the sake of my ethics. Or you may have decided, come on, it's only $100. It's not that much money. It'd be too much fun just to stir things up and see what happens. Push the button. Or maybe you just have a competitive streak and you'd be pissed if anybody else ended up ahead of you. Right? So your job is to decide which, if any of these, are rational. All right, so it's time to push the button. And because I don't know how to use the poll feature in here, try and be honest with yourself. Say it out loud. Do you push the button or not? What is it that you're going to do? Make your decision and stand by it. Ready for the result? Well, generally when we do this, and this is something that's done, the actual game is technically called something else, but it's done thousands of times every year, and you can look at the results for any sort of prisoner's dilemma game, which is essentially what this is. And when you look at groups of strangers playing this game with no formal training in game theory, usually about 50% of the people will push the button. You can put it into that context. Or in the case of traders, and I do this a lot with the traders that I work with, usually it's about 70 to 75% that push the button. So if that's the case, if you didn't push, you broke. And if you did push, you still have $35. You might think, well, so what? That doesn't really impact me, right? It's just a game. And that's the way a lot of traders feel when they're trading on their simulator. Oh, it's just a game. Oh, I didn't really lose that money. And that's the struggle where a lot of people get to. So I would encourage you to think about how you answered this. If you were truly honest, did you push the button? Did you not push the button? You might be surprised how much it correlates to your capacity to either become a successful trader or overcome what you're stuck in, or there's some people who just have a personality that doesn't necessarily work well with this industry. So, not to try and talk anybody out of becoming a trader, but there's definitely some correlation there, okay? My point is that it's really not a game. If you think about it, we defined a set of possible moves by which players interacted with each other. And everybody had common knowledge of the structure of the game. And they made rational decisions about various strategies of how to play the game. and those strategies led to their best expected payoff. And whether or not they achieved it, it really only depends on how rational they were about the knowledge of the game. So when we talk about players, common knowledge, strategies, and payoffs, these are what make a game in game theory. And if you change the context of the game by replacing players with traders, so let's say our button pushers represent a large set of trend-following traders, all long in the market together. And pushing the button means that those who do are suddenly taking profit or even reversing into a short. Okay? Now when we have this 70-30 split, it's a lot more than just a silly game, right? If that happens to you and you're on the wrong side of that, you're going to get liquidated. What does this mean? Well, to me, if I think about a 70-30 split in the market or a 70-30 split in the way that traders interact with the market, it means one of two things. And the first is pretty obvious, that common knowledge of trading information isn't really all that common. So my question is, why are traders chasing strategies without all of the information that's available to them? Right? Or the other option, which is probably a little bit more obvious, the game of trading, it's inherently dangerous to those who can't figure out when or how to push the button correctly. They represent a constant pool of novice traders that are generally very easy to liquidate. Let's take this approach for a minute. Right? Earlier I said that game theory is the study of strategic, interactive decision-making. Various groups of individuals, each with our own beliefs and goals and information, responding to the decisions of others. So take that notion and flip it around a little bit so that it really fits into traders. Flip it into they, representing professionals, institutions, algos, liquidating you, the novice individual trader. Now, please don't, I'm not trying to offend anybody and speak directly and say you're all these novice idiots. That's not the point. The point is very simple, that it's kind of like if you sit down at the poker table and you don't know who the sucker is, guess what? It's you. So, for those of you who are more on the more confident side of this, feeling like you fall into the they, well then by all means, and you can probably correlate a lot of this information. But my point is that they are going to ask, what's the best way to play the game that we're in? And how do we recognize games that are just not so good for us? And then if we do get stuck in that type of game, how do we change the game so that we might do better? Right? Most novice traders are never even going to ask these questions. They're looking for ways to game the system, something they can buy, something they can, seminar they can go to, something, software program, whatever it is. They'd rather game the system than try and model, instead of understanding models, to understand how to play the game better. See, as a beginner, you tend to engage in what's called ex post rationality, and that essentially means that you're more likely to look backwards to see how earlier situations could have been done better than they are to look forward and examine the current situation in its own right. And that's what I think order flow does most, is model the current situation, which I think is what everybody lacks, almost everybody lacks in their trading. So the big question is, how do we bridge the gap between all of this? Well, for starters, we need a basic model of how trading correlates to game theory. Earlier I told you players, strategies, payoffs, and common knowledge are the key components of a game in game theory. In trading, our players are represented by the various market participants and volume in any given instrument. And we have to know our best, we have to do our best to know who they are, when they engage in the market, what their goals, information, power, belief might be. And I realize that a lot of that's very vague and, it's hard to predict. But by simply knowing where groups of like-minded traders are positioned, we can begin to model probabilities about what effect they might have on the market ahead of time. And that's called volume cluster analysis. Strategies are the various tactics that we employ to locate potential trading opportunities. There are thousands of patterns, triggers, pivots, oscillators, indicators, theories, and methods by which you might attack the market. In the game, it was easy to see that there were only two options: push or not push. But the strategy behind each choice varied between rational and irrational. Some might push for spite, some might not push for ethical reasons. I mean, clearly these are irrational given the nature of that particular game. So when you look at trading strategies, there's much more to it than just coming up with an idea about how you feel about the market. You need to think rationally and be able to model the potential outcomes. And those outcomes are called payoffs. in trading, we're generally talking about risk to reward. What can we expect to gain if we're right? How often should we expect to make that gain? What are the consequences of being wrong? And more importantly, when we are wrong, what can we do to reduce those negative consequences? Those are all fairly straightforward. And for me, the game changer has been learning to understand common knowledge. Okay? And I can't say that I know everything that a trader at Goldman knows about their strategy for the day. But I do know with a pretty high degree of accuracy when specific events in the market begin to unfold in conjunction with my potential strategies. And that's due to order flow analysis. So think of it this way. In our button game, if you had known that 70 of the other players were pushing their buttons at the exact time that you had to decide, I can assure you that at least most of the other 30 would have pushed the button too. Maybe not everybody. I mean, I know there are some irrational people out there, but by leveling the playing field to a point where you can actually interpret the potential strategies of the rest of the players at the moment that most concerns you, meaning precisely when you're trying to execute a well thought out trade or pushing a silly button in the game, this provides the common knowledge I believe is required to compete in the game effectively. Let's take a look at some order flow basics. There's 4 primary concepts in order flow that give a trader direct feedback about the player's potential payoffs and ultimately the missing common knowledge. These don't relate directly to the strategy component, so I want to be very clear up front that order flow or anything that my company is associated with is not some system in a box. That's not what we do. To us, there's no box at all. I always tell people that we're completely out of the box, and what I mean by that is that order flow is something that can be used with just about any set of trading tactics that have a defined risk-to-reward modeling process. So for me, that usually means simple price patterns or point-and-figure charts. We have a lot of traders that use market profile, volume profiles, swing trading maps, pivots, anything that, in common terms would generate entries, targets, and stops. The point is that for just about any process out there that you can model as being a profitable support and resistance strategy under the right circumstances, using order flow analysis will really assist in defining what those circumstances are as your common knowledge. So let's narrow this down for simplicity because there's a lot of stuff on the board. And my hope is that this can be kind of an introduction class on one component. And now I just want to narrow it down to simplicity. The primary focus today is going to be reading the print. Okay, and that's always a very tricky thing to say. It's hard for people to define that when they're asked because there are a lot of different, I guess, concepts or tools or ideas about what that is. So let me define it for you in my own words. I mean looking for situations where specific patterns form to indicate the short-term flow of orders is driving trade in one direction. Okay, now I call that momentum in the print. We'll look at very specific examples of that, and I'll do my best to explain exactly what that is. But I don't want to turn you away and make you think that that's the only thing that could possibly mean to us as well. We could look for other patterns like a sweep of orders, which is kind of one of those situations that, well, we'll actually have an example of that in a little bit that I'll show you. But for those of you who have been into Delta land, I'll just put it that way. It's kind of when you think that everything should be going in one direction, but it really ends up going in the other, and then that's when you realize that there are, in fact, 2 sides to every trade. So we'll look at some specific examples of that, but also exhaustion patterns. And then, more than anything, if the trade action just looks like a total mess with no discernible patterns to follow, that's really the key to what we do. Are we seeing short-term momentum, exhaustion, reversals, or is it just wishful thinking? So we're just going to stick on one topic for now and focus on simplified patterns of momentum. And then on top of that, I'm going to use a very specific trading tactic too. This way, if you want to replicate it on your own, you can. And as I said, it's like the best luck that today it's exactly what's on one of the charts because they're not that common. So it'll be good that that you can use something that's right there in front of you, it's a profitable price pattern, and it has a lot of well-researched risk-to-reward models. So we're essentially letting somebody else do a lot of the work for us. Okay, so what I'm going to show you now is a style of trading that we call decision point trading. And what I mean by that is that rather than waiting for a series of triggers from indicators or something, we're going to make assumptions about the trade based on predefined price regions. And we call those decision points because we'll essentially have to make a trading decision when or if we get there. So in honor of Big Mike, this is called the Big M pattern. I thought it was fitting. And as I said, it's not extremely common, but it can be found in just about any time frame on any instrument, and it has very unique market psychology characteristics because if you can see kind of the left side of it, what's happening is a really steep rise that comes out of a range, and then it forms a very shallow double top. The theory behind this is that once it's confirmed by breaking down past that shallow valley up at the double top, then you can sell the breakdown, and so essentially that would be your decision point. When you cross that, the low of the valley, up at the top, that would be your decision point. And then the theory is that if you were to sell that, you would put up a stop up above the double top, and then you should be able to sell it all the way back down. Then you're going to have this what basically forms into a big M on the chart. So I'm sure you guys can all see that there, even in my artist's crayon drawing here. Everything I was talking about here is, I'm saying theory and theoretical and this and that, and I know just from reading a couple of the blogs that, or the posts that Mike himself is not a big fan of most chart patterns. And that's kind of the beauty of it, is that you can take something that somebody else has already done a whole lot of work on, and you can try and zero in on things, because in theory, this usually fails. I mean, you can look at it over and over and over again, and the number of them that actually make this pattern and get all the way down there without getting jumbled up somewhere in between, or going, even in the context of the pattern that I think ended up on today's chart, there's a huge stop involved if you were to actually follow this. I kind of look at it a different way, and if you follow what the gurus say, all the people who have really done a lot of work in chart patterns, and if you listen to what they say, most of them will tell you that the 50% mark of the rise on the way back up is usually about as far as this is going to go. So that's where it says 50% target 1. They still use the same confirmation point, but say, oh, well, it really should only go about 50%. And then there's others that'll tell you that it's not so much about being 50% as much as it is wherever that breakout of the range came in. So that's where it says target 2 there. And if you ask me, I think that if this works properly and you have enough information, rather than trying to carry this all the way down to wherever the low was of the original rise out, I'll usually look for some sort of little trend line out of whatever the lower range is. So you can see that green line across the bottom where it says target 3. That would be where I would tell you this is going to go, but only with enough information. So I don't want to put myself into the land of the gurus just yet. What I want to focus on here is that even if you're listening to Guru 1, Guru 2, or to me, if we're all talking about the same stop, this is a risk-to-reward nightmare. I mean, it's a total disaster. The first target looks like it's less than the amount that you're going to risk. The second target, if you tried to trade it to the breakout, looks to be about even, so risk equals reward. And the third target is the only one where the reward actually outweighs the risk, right? And we've already said that most of them aren't going to get there. The theory usually fails. So the big question is, how do we pick the ones that actually get to that the only target that we're interested in, whether it's my target or somebody else's? I mean, you're obviously not looking for trades that are less than 1-to-1 or 1-to-1, and if you are, I don't know, you might want to reconsider what you're doing. Or so let's look at some real charts here. This is they don't have labels, ES and Euro. I think the Euro's on the left. I apologize. They should have labels somewhere. These are both big M's from earlier in last month. I think it was about the 7th and the 8th. So not the same day, but two different instruments. And for those of you who can't see the patterns, mark them up here on the chart. They're not exactly the same. There's some different characteristics in the two markets, but they more or less it's the exact same thing. It's that steep rise out of a range, very shallow double top, and then whether or not they roll over. There are the labels. There we go. Okay, so the question is, if you look at it, the Euro worked and the ES didn't work. So why did one of them work and one of them not work? And the truth is that I can't even say that the second one didn't work, because if you look close, it looks like it went to either the range breakout or the 50% mark. So one of the gurus was correct here. So it'd be hard to say that this actually failed, right? But there's definitely a difference because the first one, it didn't stop at the 50% or at the range breakout. It traded all the way back down and essentially, all right, so you can see that the 6E basically does trade all the way down and the ES doesn't. But like I said, I mean, who's to say that that's wrong if most of the gurus out there say they're not going to go 50%? So my question is, what's really holding this up? Is there something inside these candles that's making a difference? Is there something that we can't see? And obviously my simple answer would be yes. There must be. I don't think that it's just probabilities that some of these work out and some of them don't. And so the question is, what's the best way to play the game we're in? And how do we recognize the ones that are not that good for us? Well, if I'm going to take you back to the crayon for a minute and tell you how I do this with momentum, it's more or less the same. I just want to look at every one of these kind of decision points that are along the way. So if I just take everybody's word for it and say 50% is the magic number on this particular pattern, or the breakout's the magic number, or my target's the magic number, obviously I want to go in and look at the print, and I want to see what took place there. I want to know if there's anything that might be in the way of getting to the target. I mean, most importantly, I want to confirm that the breakdown across that little valley actually has momentum, because I don't want to just sell into it because it's a pattern on a chart and it may have this huge risk, that ends up potentially having good reward. The only way I'm going to execute in any possible way into this is if I have momentum in the print, and that'll really help because we can throw away that big stop that we were talking about. Forget about the stop at the double top. If we have momentum in the print, I'm going to show you how you can use that as guidance for a very small stop, so that you're really looking at things in a much different way than what, I guess, the way that the guys who write these pattern books look at things. I'm convinced that a lot of them aren't actual traders, because I can't imagine how anybody would be able to put on some of the risk that they do. But that's not to say that everybody who writes books isn't a trader. I just, to me, you can look at some of these and say that there's absolutely no way that anybody would ever do that. So keep in mind, the way that this works is that we're going to use a tactic for guidance. So in this case, I'm talking about a very simple chart pattern. All right, and then we want to use the current print to execute and manage. So that's that modeling the current situation. And then we want to use the history as well, so that we can look at things that might give us trouble and then also project out into the future for a target. So I'm a big believer that any complex system has to have an equal balance between historical, current, and future. Most of us live in that world of, we look at the history and then we backtest and backtest and backtest to try and project the future, and we wonder why that never pans out. But the minute that you go through any paperwork on anything to do with trading, what's the first thing that you have to recognize that it says? I think even on Big Mike's slides it says it. Past performance is not indicative of future results. I mean, it's right there in black and white, but we don't believe it, even though we sign next to it and say, yes, I accept that, and, but for some reason we can't take that out of our head. So I truly believe that rather than just past and future, getting in the current is what makes the difference. All right, so about now, some of you are probably saying, great, what's the print? I know some of you are very skilled in this and others are just getting their first taste. So you need to keep in mind that financial markets are actually auctions, and that auctions have to have buyers and sellers in order to work. Buyers obviously want to pay less, and sellers want to sell for more. So what that means is that we're always going to have two prices in the market. Even though on your chart you may just see one, that indicates the last trade price, which in this case is what's yellow in the little dome there. But the ask is, you've got an ask or an offer price that the sellers are trying to get, and a bid or buying price that buyers are trying to pay. So you're always going to have some split between two prices there, and generally in futures, liquid futures markets are always going to have a one-tick spread. If we look at this, in this case we have a best offer at 1337 of 189 contracts, and a best bid of 128 contracts at 1336.75. So essentially, we would need 190 longs to push the offer to 1337.25. I realize that that is a very goofy statement to say and something that's as fluid and liquid as a futures market is, but if we were to freeze time for just a moment and say, what do we need to trade right now in order to push the offer up from 37 to 37.25, what do you think the answer is? Well, we have to trade through whatever the best offer is, so we trade the 189 through. That would mean we would need 190 technically to push the offer up. On the other side of it, to push the bid down one price level, we'd need 129 market shorts to come in. So there's 128 being offered. We'd have to clear that and then push into the next offer. Take whatever it is and add one to it. All right, so here's our first quiz, and so we'll give away a software license for OFA Ninja for whoever can answer this. How many market shorts would push the bid to 1336 even? So right now the current is 1336.75. What's going to push it down to 1336? Again, if you could magically freeze time. All right, well, whoever put up 799 first just won a license. All right, well, congratulations, Najib. We're looking forward to having you learn a little bit more about order flow. All right, so from here, we need to take that into that idea that being able to push the bid or the offer one direction or the other into a little bit more depth. Okay, so essentially when we're talking about order flow or strike volume, strike price comparisons, what we're doing is we're comparing the last trade size or whatever the volume is against whatever the current bid or ask is. So if you have an ask price of 37 and bid price of 36.75 and two contracts traded there, the way it works out is two contracts traded at 36.75 when 36.75 was the bid price. Therefore, two contracts struck at the bid at 36.75. Now, I know that sounds repetitive, but that's technically what the print is. That is the print right now that just happened. Two contracts struck at the bid at 1336.75. Okay, again, so what? Well, the reason it's important is because this is how we begin charting order flow. Right? So anytime that we do this, we take all the volume struck at the bid and put it on the left, and all the volume struck at the ask and we put it on the right. And we do that obviously in correlation with price so that we can see where volume came in on one side or the other at any given price at any given time. Now, there are a lot of uses for this. Probably the most common one for this is known as delta analysis, and that essentially means that you're taking, at any given price, you're taking the ask volume minus the bid volume to get what's known as a delta. So if you guys can look at the 1654 level, we have 4,479 on the ask and then 5,374 on the bid side. So if you take one minus the other, you're talking about negative 895. So in the world of delta analysis, that would mean that you have a bid trade or seller bias at 1654. I kind of have my own issues with this. We'll get into them. I think you know, it doesn't make a lot of sense to me, but if you believe it, then that's what you're saying, is that at that price there was this negative balance or a balance of sellers. You can also use this for what's known as cumulative delta analysis, which would be where we would take the total ask minus the total bid of everything in the period. So in this case, if we took everything on the right and subtracted everything on the left from it, we'd end up with negative 1,669. The context of that is a little bit difficult to read. In this case, we have a period that's technically closing higher. So it's a move up. We've gone up from 63.25 up to 56.25, and we're closing higher, but we have more bid trade, so there's a sell side bias. You know, again, I think it's really a stretch, and this is my argument with the delta world, because you have to start treating everything as though every contract just has one buyer or one seller, and we all know that every time a contract's executed, there's a buyer and seller for every contract. So it doesn't make a lot of sense to me, but again, it can be used for that. And then another thing that this type of charting can be used for is what we call volume cluster analysis. Volume node analysis, it's been called a lot of different things lately. And essentially what we're talking about is a single group of prices where more or less the highest concentration of volume is. So in this case, it might be here. And we can gain a lot of insight from whether or not, as this volume was building, whether we were trading into a node of volume or away from a node of volume or through a node of volume, or in this case, as we pushed down, we were unable to actually move much below the node of volume and then lift it up and got on top of it, so we may be able to interpret what's going to be happening with various stops that might come out based on people being stuck on the wrong side of something. Either way, these three things are really kind of the primary reason for charting in this format. And the funny thing is that contrary to popular belief, and I would really say more than popular belief, but just marketing efforts by various companies out there, this is not reading the print. This doesn't really have anything to do with reading the print. I mean, these are derivatives of things that we're talking about here, one minus the other maybe, or groups of them together, but it's really not reading the print. So today I want to make sure that we get down to really the key elements of reading the print, what it means to me anyways, and you can take it or leave it. The first thing is that you have to have directional action in the market. And more importantly than that, you have to understand what the directional action was. Okay, so, and this is going to seem a little remedial here, but I mean, in this case, we opened and moved up to 1630 from 1627.50. And then we collapsed all the way back down to 1627, and then we ended up closing up a little bit here at 27.75. All right. In the second case, we have price opening at 55.50 and dropping to 53.25, and then moving all the way up to 56.25 and all the way back, or not all the way back down, but rotating back down into 55.50. Now, the thing that's important about this is understanding that if we're not paying attention to the directional action in the market, where the market's been, and what the print has done in that movement, in that directional movement, then it's really hard to put any of this in any context. Because if, for example, you plot, say, 15-minute or hourly periods that are not bound by anything other than time, the market's going to be moving across several price levels over and over and over and over and over again, and it's just going to be volume piling on top of volume, and you'll never have any awareness as to whether or not there are actual contracts that have been executed at one point that then had to unwind somewhere else. It just starts to look like a giant pile, and you get a lot of that in, there's a lot of correlation to that in volume profile or market profile when people are looking at distributions of either volume or TPOs, and there's a reason you want to play around on the fringe. It's the only place that you know that there's actually somebody that's going to be affected by trade. Everywhere else, it's questionable at best. So one of the things you'll notice when we go through the software is that rather than just plotting things as kind of candle with numbers in it, you can see here in this case, one of them, even though they're both, well, I shouldn't say they're both up periods, but the body on the one on the left is closed higher than it opened, but it has a red wick. And the red wick is to define the overall directional action that took place within the period. And obviously in the one on the right, you can see that the wick is green. Even though it's a doji, the overall directional action was a move higher. And that's very important for us. The other thing is that I think that we need to compare strength and weakness diagonally rather than at a single price, because a price is never the bid and the ask at the same time. So this is where my tragic delta dilemma thing comes in. And, I've got some enemies because of it. But if you actually think about the way the market trades, we're never at the bid and the ask at the same time. The bid is always below and the ask is always above. And that's truly how we should be comparing the print when that's what we're talking about. If we're talking about something that's struck at the bid or at the ask, it makes sense to correlate that to the time in which it was trading at the bid and at the ask, which is always, at least in futures, going to be a tick apart. And really, rather than being worried about one minus the other, it should just be a process of which one's stronger and by how much. As an example, we earlier determined that the delta of 54 was negative 895. In other words, there's a sell-side bias here at 1654. But if we compare it diagonally, we can see that the ask side is actually 2-to-1 over the bid. 2-to-1. So is it the negative one, where it's 895 at 54, or was there a 2-to-1 differential between the 53.75 and 54.25? Now you can look up the thing and say, well, gosh, DB, the next one has negative, so technically it is negative. It's at 54, and that may be the case, but that's the third thing that I think is the key to reading the print, is that it's not enough to look at any single price. We really need to have a sequence of prices in order to develop any sort of a pattern. I think that a single strong or weak print, it really doesn't mean anything. I mean, I call it two-sided trade, and we see an awful lot of it. And so instead, I prefer that you look at it sequentially. So take a look. If we look at the next price, we have 3,176 against 1916. That's, again, almost 2 to 1. We have 279 against 42. That's like 6.5 to 1. So we've got this sequence of strong ask print moving off of the low of a period. Now tell me anywhere in that period that has any other sequence like that. Doesn't exist. Every single price either has maybe 2 to the up or 1 to the down or 2 to the up or 1 to the, that's the only place that we have a sequence of events that takes place in there. So really, the way I look at it is we have sequential ask strength off the low, and that tells me a lot about why this period closed up 3 points, you know, from where the bottom of it was. It moved down. It obviously stopped the downward action, turned around, and moved right back up. And I think it's much more important to be looking at a sequence of diagonal strength or weakness than it is to be trying to look across any one given price and say that there's some massive subtraction factor. So in our new application, that's one of the things that we've really focused on, because as long as I've been teaching this stuff, and it's been for a long time, the biggest thing for people to overcome, because they like to have lots of stuff on their chart and look at lots of different things at the same time, is actually learning how to read the print. So I decided that I was going to come up with a very easy way to be able to not only see what's going on in the print, understand how fluid the print is. It can look like one thing 1 second and something else, you know, completely in another 2 or 3 seconds. It was important for me to really focus in on getting the print to be visible. So the way that we've done this is we classify the print as it comes in as either strong trade at the ask, strong trade at the bid, which would be represented in blue, in red, so red and green accordingly, or if it's weak trade, because sometimes we can have situations like at 54 quarter here we have a weak print, but not necessarily a strong print on the bid side of that at 54 even. So we wanted to isolate weak print areas too, because a lot of times when we're looking for exhaustion patterns as opposed to momentum patterns, we not only need to see strength in one direction, but we need to see weakness as well. And then neutral trade, which in this case is represented by white, so the white text there. And then we also built in basically a set of different algorithms so that it was very easy for us to identify patterns like this. And this is essentially the exact same stuff we were just looking at. So instead of looking at it as some sell side negative bias, which is what the delta was telling us, we're looking at it and saying, hey, the pattern of the print tells us this is pretty darn strong. And basically what we've done is come up with some different algorithms for different instruments, everything in my book from the ES, which is a very, very thick book that has massive print all day long, to general commodities and currencies that have a much more functional, moderate scale, all the way down to things like the Russell that are just, in my book, paper thin. And obviously what we wanted working inside of NinjaTrader in this case was to make those things custom strategy variables for those of you who really want to program your own stuff and do your own thing. So we really spent a lot of time this time around making it about reading the print instead of saying, hey, we're about order flow, but we're really focused on all these different things. I think we've really nailed it in terms of those of you who are interested in truly understanding what's going on in the print. You can see here what ends up happening, and obviously I'm cherry picking something out of this, so but we'll look at real examples. When you look at this, what ends up happening out of a pattern like this is that we not only break away from it, in this case up to the high of that period going up into 56 quarter, but then as we come back down into it, we end up finding support there. And then lifting up again, and you can see, oh, my arrows are a little bit off, but once we hit 57, there's another pocket there. I don't know if you guys can see that, but there's another little pocket here of momentum that, again, thrusts the market out. And that's really what's key, is being able to see these things in terms of easy to define patterns, and then be able to really build on that yourself. So that's the overall game plan, and I'm going to go into some examples. So let me get through this. What we're going to be looking for is essentially selling momentum, like we see here. In this case, I was telling you that big stops that are defined by all this back testing aren't necessarily really needed when you start understanding what's going on in the current. We're usually looking at a situation where there's momentum in the print and saying, if it's true momentum, it's not going to trade back through it. And if it does, then it's a whole different animal. It's what we would call a sweep, telling us that we were wrong about where the strength was. And so usually you're not ever going to have a stop anywhere but a few ticks behind where you actually see the momentum. Now, there could be situations where there's an awful lot of momentum, which would make it a much larger stop. But the point is that, to follow some book writing guru's idea about, well, you need to have your stop above the double top and all of that, come on, that's ridiculous. You need to be looking inside to see what's going on, and then once you determine what's going on, you can make a real judgment about where to put stops. This one on the ES, this is some sell-side momentum again, and this one does the same thing. It pulls back into that momentum area, but it doesn't break through it until trading down, another 3 points, and then we can see the buying momentum off of the bottom, and then, of course, more pushing us up. So again, areas where we have the market breaking away and coming back and finding support at those levels. This would obviously be a larger stop environment than something like this, but I think that's a good illustration of the kind of stuff that we're going to be looking for. Good. Okay, so today I'm going to go through those examples that we looked at earlier, the one where I said, gosh, why did this one work and this one not work? And what we're going to be looking for is this idea, and I'm going to keep it very simple. And when I say that, guys, what I mean is, do not take this as the rules of the game, because I don't want to oversimplify to the point where you honestly think that every time you see 3 red things in a row you would go short, or 3 green things in a row you would go long. Again, that would be very irresponsible. This is not a system in a box. It's not anything like that. I'm trying to illustrate a point with how you can apply this, and it doesn't matter whether you like chart patterns, or you're a profile person, or you have pivot points, or you call the astrologist on the line and she gives you numbers every day that you look at. It doesn't make any difference. The idea is to help you make trading decisions when it's critical for you. So we're going to be talking about 3 consecutive strong bid prints, 3 consecutive strong ask prints, and again, at our strategy decision points, which that's the first thing that we've got to do, is go through and line up. So in this case, this is the ES. This was the first example, and we have a high at 27.50 and a low at 17 even. So we said the gurus say 50%. Okay, well, that's going to be 22.25 off of those numbers. So that would be our first decision point. The reason I'm saying that is that if we look at it from a historical standpoint, we ought to go back and say, is there anything in that area that's going to be difficult for us to trade through? And that'll be the first step. The second step we said was, well, some of the gurus say that it's when you break out of the range that we need to be concerned. Well, those are almost overlapping in this case. They're very close to each other. So again, still in that, the first one was 22.25, and now we're right around the 21.5 area. So we've got a little bit of a range that we'll definitely be checking out there. And then I told you that what my target would be on all of this is, if I look back at whatever the range has been before this big M pattern forms, and guys, a big M pattern is a breakout of a range, so there's always going to be some sort of a range. So I'll draw a trend line like the one that you see here, and in this case it tells me that the target, if everything else goes smoothly, should be somewhere around 18 to 19. So if I'm looking at the big M up top and I'm saying, well, the high of it is 27 something and the low of it, the low of the valley is 25, even if I went along with the guys saying put your stop behind above the double top, that's a pretty good risk to reward, but I still have to make sure everything else will work out. And then, of course, the most important piece of the puzzle is saying what happens in the current, right? So we've got to look at that breakdown, in this case across the 25 low, and say, is there momentum there? Am I actually going to take a trade that I'm calling a momentum breakdown in this case? If there's no momentum in the print, that would be fairly foolish. That gives us these decision points, 2150 to 2250. That's about where that midpoint and range breakout is. And the question is, can we trade through it? Is there anything possibly in our way? And then 18 to 19, is that a reasonable target down there? Is it reasonable that we should even be thinking about getting down there? And then the most important point, what happens at 1625? All right, so for those of you that are not familiar with an order flow chart, you might not be able to see the big M in here because, as I said, we don't really work in a matter of time like the 5 and 15-minute charts. But this is really what the M looks like, even though it doesn't much look like that. So we break out of the range, go up, make a high, then we dip down a little bit and make the second high, and then we come down. And instead of trading through the lows, we actually end up holding and then trading all the way back up. So that target down there at the 18 to 19 clearly never reached. Now in this case, I want to go into this section by section so you can really see what we're talking about and not have some big crazy chart with lots of validity numbers. Our decision points in this case, the first one that we said was going to be important was 2150 to 2250. Can we trade through it? Well, my assumption is you guys can see this. Hopefully you can. I'll zoom in a little bit here. This is the 2150. Oops, not just 3. This is 5 consecutive really strong prints to the ask. Okay, so we know that there was already strong buying momentum there. That's not really going to play very well for our overall target down below. We should just know ahead of time that we might not reach it. It's not to say that we won't. Strong momentum gets sold through, it does. But to me, this is like having a big speed bump in the road. Okay, the reason being that we know we have to clear 25. 25 is our breakdown confirmation. So if all we're going to do is trade to 2250, unless we actually get in exactly at 25, we're talking about maybe 1.5 or 2 points by the time it's all said and done before we hit this wall of prior momentum where there was a lot of strength. Okay, so to me, I would kind of say that this trade's over before it starts, but it's important we look at the next piece of the puzzle here, and you can really see in this case where that momentum held. Okay, we didn't trade down through 25 with the momentum that would have put us into this trade. I don't have a little box here or anything, but that 25 is here. Okay, so if we're looking at, well, are we going to short the breakdown? I mean, this is kind of the opposite of what we would look for momentum. Instead of having 3 consecutive red prints, we basically have a lot of weak prints, neutral prints, 1 strong print. This is not the kind of thing that we're going to take the short on anyways. So not only would we not be in it because we wouldn't have had the momentum, but then our risk to reward was kind of a little bit screwed up there anyways. If we had gotten a perfect print of momentum, you can see what happens. It goes into this strong momentum and it's just hold. So it's really key that we look at that from kind of the history of what happened and then also what's going on in the real time. In this case, we actually ended up trading back up, and if you can think about trading through the top of a double top with momentum, we had kind of a whole different thing going on here. This was towards the tail end of the day, and that's a whole different pattern and different decision points. But obviously, we held the prior momentum and then traded up and busted out of the top with new momentum. So fairly significant. So just to kind of recap those decision points, starting from the bottom. One of the key elements here that told us that we probably weren't going to trade all the way down to the big M, like I would like to see, or anybody else taking this would like to see, is the fact that we had buying momentum across that 2150, 2250. And it was very clear where we stopped on the breakdown down at 2250. I mean, it held perfectly. Probably the most important thing is the middle piece. There wasn't any selling momentum, so there was no reason for us to get into the trade in the first place. And then not only did it hold and ultimately fail out of the top, but we see buying momentum out of the top. So this ES that we said maybe didn't work as a trade, totally different. We've got a good idea of what that failure to produce really looks like. So the big question is, what does the other chart look like? What's different about the euro? All right, so I want to go through this a little bit faster than the last time because it's essentially the same thing. We already said that the 3104, we'll call it 3105 given the answer, would be the midpoint, and then of course we have the range breakout, this time a little bit lower so they're not on top of each other like they were the first time. And then we have what I would consider the lower target area, and then probably the most important aspect here, what happens on the actual breakdown. So if we take, and of course I had 3104, but we'll say 3105, 3097 being the range high, 3080-ish being about where the target should be, and then of course the most important 3107. Okay. Now, when we look at the order flow chart in this case, it's the euro. There's a little bit more movement, so you really can see the big M. I don't want to mislead you, for those of you who are trying to actually write down the trading strategy here, that somehow because this looks like a better big M on the chart, that it's a better one. They don't all look perfect, and that's why I wanted to give one that was kind of hard to read and one that was a little easier. But again, we'll just zoom in section by section here and try and get a. What we were talking about was the fact that we had the first point being that range high, and what do we see in the print? And I'm going to zoom in on this, so don't worry about not being able to see it if it's not clear enough just yet. The 50% point, which was 3104, 3105. There we actually have some momentum, and so we have to look at it and see whether or not it makes any sense. And then our confirmation point to break down on the big M is 3107. So I'm going to zoom in on this a little bit because it can get a little bit confusing. Okay, in the at the range high at that 97, 98 area. It looks like we're almost there. We almost have it, but in terms of really being in sequence with what we're looking for, it's not there. And in fact, we even backed down and traded back through that. So it kind of validates for me the fact that I don't need to worry so much about the 95 area, 95 to 97. I think we shouldn't have any problem trading through that. There's nothing really solid there that piques my curiosity. When I was talking about the 50% level, 3104, 3105, well, gosh, it's there, isn't it? All right. So we may have a lot of trouble getting through the 50% mark. But guys, our confirmation point is 3107. So if we don't trade through this anyways, we're not going to be in a trade no matter what. So it's one of those situations where, yeah, we're looking at it and saying, okay, 3105 could be difficult to trade through. But we won't be in a trade unless we clear 35 with momentum. So I think this is one of those perfect examples where everything down below is telling us, hey, if you can get through that one point, you ought to have a really nice trade. Well, when we do trade down and make the bottom of the M, that's exactly where it traded to. So that's why we have that hopefully from the last chart that now makes a little bit more sense. 3107 was our confirmation point that we had to break down through. Well, the reason this held is because of the original buying momentum there. So clearly we're going to have selling momentum through this in order to get into a trade. Okay? So I just wanted to be clear on that because it can get a little bit confusing when you start looking in at all these little numbers. But in this case, that's exactly what does happen. You can see the selling momentum that comes in and trades through that. So basically from about 3103 down to 3199, we have selling momentum that does come in. And so technically at the 3107, no, but we ended up trading momentum right through all of the buying momentum here and shorting or providing that kind of confirmation that it's okay to short. So we didn't just put on a sell stop order for selling momentum here at 3106. In this case, that might have been better, but if we were going to follow that advice, we'd have to have a stop up at 3136. So in this case, we do see the strong selling momentum through. That would essentially free us up to take a short. We would want to short with that momentum. So you can look at this chart and kind of see, we see this momentum across 03 to 98. As I said, you're never going to have a stop up where the gurus tell you to have a stop. It just wouldn't make any sense. You've got your stop behind the momentum and your target area down here in the 80s. I don't like it when people do stuff like this because it's like, oh, well, I would have gotten this perfect fill of whatever. So let's just take it. Let's say that you didn't even get the actual short inside the momentum. Okay, let's say that the momentum expired before you ever got there, even though it pulled back up into 31.10. Just to kind of keep the numbers simple here, if you're short 30.98 and you've got to stop at 31.04, that's a 6-tick drawdown. And if our target is 30.80, that's an 18-tick gain. That's how we do our risk to reward, and that's a calculation that we're always working in the moment, because we can make the assumption that we're going to short somewhere around 31.07, but if we don't actually get the short there, we always need to be thinking about what's left in the target, what's left in the target, what's left in the target. In this case, maybe 18 ticks. Okay, so that gives us a risk to reward of 1 to 3. In other words, for every 1 tick that we risked, we're expecting to gain 3. That's an acceptable trade. Okay, there's nothing wrong with a trade that looks like that. And those are the kind of things that you should strive for. And when you've got a tool that will help you validate areas like this and give you those small stop opportunities, and will you get stopped out sometimes? Sure. But I mean, logically, if you are trading with momentum, it shouldn't trade back up through the momentum or back down through the momentum with buy-side momentum. So just